Before we begin, it's crucial to state that I am not a licensed financial advisor, insurance agent, or legal professional. This presentation is for educational and informational purposes only and does not constitute financial, legal, or insurance advice. The world of insurance is complex and highly individualized. You should always consult with a qualified and licensed professional who can assess your specific situation before making any decisions. This video is intended to be a starting point for your own research and due diligence, not a substitute for personalized professional guidance. Let's be honest for a second. Have you ever had that flash of a thought, maybe late at night or on a long drive, about what would happen to your family if you were suddenly gone? It's a thought we all push away. It's uncomfortable. It's terrifying. One moment you're here providing, protecting, planning for the future, and the next you're not. And your family is left not only with unimaginable grief, but with a sudden, crushing financial reality. The mortgage payment that was due on the first, the car loans, the credit card bills, the dream of sending your kids to college, all of it, a mountain of financial pressure landing squarely on their shoulders at the worst possible moment of their lives. This is the single greatest fear for anyone with people who depend on them, and it's the exact reason life insurance was invented. But for most of us, that's where the clarity ends. The moment you decide to do the responsible thing and look into it, you're hit with a tidal wave of confusion. Term life, whole life, universal life, riders, premiums, death benefits. It's a language designed to be intimidating. You're talking to agents who might be more interested in their commission than your family's well-being, pushing complicated products you don't understand. You get quotes that are all over the map, and you're left wondering, am I paying too much? Am I buying the right thing? Am I being taken for a ride? The process is so broken, so frustrating that millions of people just give up, leaving their families completely exposed. But what if I told you there was a fundamentally different way to do it? What if the secret to getting the best life insurance wasn't about finding the right company, but about finding the right advocate? And what if I told you that one of the most trusted names in the industry, a name recommended for decades by personal finance giant Dave Ramsey, isn't even an insurance company at all? This is where Zander Insurance enters the picture. And over the course of this presentation, we are going to demystify this company entirely. We're going to pull back the curtain and show you exactly who they are, what they do, and how their unique approach has completely changed the game for millions of American families. By the end of this, you will understand their process from start to finish. You'll know why they are so highly recommended. And most importantly, you will have a clear, actionable roadmap to getting the right protection for your family, without the confusion, without the high-pressure sales tactics, and without the fear of overpaying. So first things first, let's clear up the biggest misconception right away. Zander does not issue life insurance policies. They aren't the ones who write the check to your family. They are what's known as an independent insurance broker. And that distinction is the most important thing you need to understand. Think about it like this. If you wanted to buy a new car, you could go to a Ford dealership. And that dealership would be fantastic at telling you all the reasons why you should buy a Ford. They'd show you every model, every feature, and try to sell you the best Ford for you. But they will never, ever tell you that a Toyota down the street might be a better fit for your needs and $1,000 cheaper. Why would they? Their job is to sell Fords. A traditional insurance agent who works for a single company is like that Ford dealer. They can only sell you the products their company offers, whether or not those are the best or most affordable options on the market. Zander is different. They're not the Ford dealership. They're more like a trusted personal car shopper. You tell them what you need. A safe, reliable family SUV with good gas mileage under a certain budget. They don't care if the best option is a Ford, a Toyota, a Honda, or a Hyundai. Their only job, their only allegiance is to you. They take your requirements and they go out and shop the entire market, comparing dozens of different options from all the top companies to find the absolute best vehicle at the absolute best price for you. That is precisely what Zander does for life insurance. They work for you, not for an insurance company. When you go to them for a quote, they take your information and instantly shop it across a curated list of highly rated insurance carriers. They bring all the offers back to you, laid out side by side, so you can see with total transparency which company is offering the most competitive rate for the coverage you need. This one simple difference in their business model is what creates the potential for massive savings and, just as importantly, massive peace of mind. You're no longer guessing if you got a good deal. You're seeing the entire market in one place. Now, you can't talk about Zander without talking about Dave Ramsey. For well over 20 years, Zander has been the only term life insurance provider that Dave Ramsey has recommended to his tens of millions of followers. This isn't just a random sponsorship. It's a partnership built on a shared, deeply held philosophy about how insurance should work. Dave Ramsey's advice is famously straightforward. He preaches that the sole purpose of life insurance is to replace your income and provide for your family if you die. That's it. It's not an investment. It's not a savings plan. It's a pure, simple protection product. Because of this philosophy, he exclusively recommends term life insurance. And this is exactly what Zander specializes in. Let's quickly break this down because it's at the core of their entire strategy. Term life insurance is the simplest, purest, and by far the most affordable type of life insurance. You buy it for a specific period or term, typically 10, 20, or 30 years. If you pass away during that term, your family gets a tax-free cash payout. If you don't, the policy expires. It's like renting protection for the years your family needs it most, when your kids are young and the mortgage is big. The alternative that many agents push is whole life insurance or other forms of cash value insurance. These policies bundle insurance with the so-called investment or savings component. They are dramatically more expensive, often 10 to 20 times the price of a term policy for the same amount of coverage. And the investment returns are notoriously terrible, bogged down by enormous fees and commissions. The Ramsey and Zander philosophy is simple. Separate your insurance from your investments. Buy cheap, simple term life insurance to protect your family, and invest the massive amount of money you save in good mutual funds. By focusing only on the best term life policies, Zander aligns perfectly with this proven wealth-building strategy. They aren't trying to upsell you on a complicated, expensive product you don't need. Their goal is to find you the most affordable protection possible, freeing up more of your money to actually build wealth. This alignment of philosophy is the bedrock of their reputation. They aren't just a marketplace. They are a curated marketplace guided by a specific, time-tested financial principle. They've already filtered out the noise and the expensive junk for you. But how does their process actually work in practice? What happens when you go to their website and ask for a quote? What are the specific companies they're getting those quotes from, and are they really the best? And how do you navigate the application and the medical exam that often follows? We're going to walk through that entire journey step by step to give you an insider's view of what you can expect and what you need to look out for. We'll also break down the critical question: how much insurance do you really need? It's probably more than you think, but we can calculate it with surprising precision. Let's start by looking at the very first step, the online quote process. When you first land on the Zander website, you're met with a simple, unassuming form. It looks like any other form on the internet, but don't be fooled. This is the gateway. Every single answer you put into these little boxes will ripple outwards, dramatically affecting the price you'll pay for the next 10, 20, or even 30 years. Think of this not as filling out a form, but as giving a deposition. Honesty and accuracy are your best friends here. The first few questions are easy. Your state of residence. That matters because insurance is regulated at the state level, so prices and rules can vary slightly. Your date of birth. This is, without a doubt, the single most important factor in determining your life insurance premium. Every single day you get older, your theoretical cost for new life insurance goes up. It's a slow, invisible creep, but it's relentless. Insurance companies operate on massive data sets called actuarial tables or mortality tables. It sounds grim, but it's just math. They can predict, with unnerving accuracy, the life expectancy of a person based on their age, gender, and health. The younger you are when you lock in your rate, the cheaper it will be forever. That's not a sales pitch. It's a mathematical certainty. Next, gender. Statistically, women in the United States live about 5 years longer than men. Because of this, women almost always pay less for life insurance than a man of the exact same age and health profile. It's not about fairness in the social sense. It's about risk in the statistical sense. Now we get to the first major fork in the road, the tobacco question. This one question can be the difference between a policy that costs you $40 a month and one that costs you well over $100. And you need to be brutally honest here. When they ask about tobacco or nicotine use, they don't just mean a pack-a-day cigarette habit. This includes vaping, chewing tobacco, nicotine pouches, nicotine gum, and even the occasional celebratory cigar. Most insurers have a look-back period, typically 12 to 24 months. If you've used any nicotine product in that window, you have to say yes. You might think, well, I quit 3 months ago, I'll just say no. That's a terrible idea. During the official application process, you'll likely have a simple medical exam which often includes a blood or urine sample. They will test for cotinine, a byproduct of nicotine that can stay in your system for days or even weeks. If you lie on the application and they find out, they can deny your application or worse, deny a future claim. That would mean all the premiums you paid were for nothing. The price difference is significant, but the price of dishonesty is infinite. After the tobacco question, you'll see a drop-down menu for your general health. This is where things get subjective, and it's the place most people get tripped up. You'll see options like excellent, good, or fair. These are just placeholders. What Zander is trying to do is get a rough idea of which health rating class you'll fall into. These classes are what the actual insurance carriers use to set your final price. Think of it like a credit score for your body. The top tier is usually called Preferred Plus or Super Preferred. This is the 850 FICO score of health. To qualify for this, you have to be a near-perfect specimen. Your height and weight are well within the ideal range, your cholesterol and blood pressure are fantastic, your immediate family history is free of early-onset cancer or heart disease, and you haven't engaged in any risky hobbies like scuba diving or skydiving in the last few years. It's the best possible rate, reserved for the healthiest applicants. One step down is Preferred. This is still an excellent rating. Maybe your cholesterol is a tiny bit elevated, or you're carrying 5 or 10 extra pounds. It's for people in great health with 1 or 2 very minor issues. The price difference between Preferred Plus and Preferred is usually pretty small. Then you have the Standard Plus and Standard categories. This is where most of us fall. Standard means you are, by the insurance company's definition, an average healthy American. Maybe you're managing high blood pressure with medication, you're 20 or 30 pounds overweight, or you had a minor health scare in the past that's now resolved. This is not a bad rating to get. It's the baseline. Standard Plus is a slight improvement on that, with slightly better rates. If you have more significant health issues like a history of heart problems, a recent cancer diagnosis, or diabetes with complications, you might fall into what are called substandard or table ratings. Zander's simple online form doesn't really account for this, but it's important to know it exists. Even if you have serious health conditions, you can often still get coverage. It will just be more expensive, and working with an experienced agent becomes even more critical. For now, just make your best guess. If you're in great shape, select Excellent. If you're generally healthy with no major issues, pick Good. The initial quote is just an estimate anyway. The real price is determined after you formally apply, and the underwriters review your medical records. Okay, now for the 2 big ones. Coverage amount and term length. This is the heart of the policy. How much money do you want to leave behind, and for how long do you want the protection to last? Let's start with the coverage amount. This is where people either guess wildly or get paralyzed by indecision. They'll pluck a number out of the air. $1 million sounds good, right? But there's a better way, a more precise way. A simple acronym to remember is DEMI. It stands for debt, income, mortgage, and education. D is for debt. Add up all of your non-mortgage debt. Car loans, student loans, credit card balances. You want your life insurance to wipe all of that out so your family starts with a clean slate. I is for income. This is the big one. How many years of your income would your family need to replace if you were gone? A common rule of thumb is 10 years. So, if you make $80,000 a year, you'd want $800,000 for income replacement. This gives your family a decade to adjust to a new financial reality without a catastrophic drop in their standard of living. M is for mortgage. How much do you have left to pay on your house? You want the policy to pay it off completely, removing the single biggest monthly expense from your family's budget. And E is for education. If you have children, how much will it cost to send them to college? The average cost of a 4-year degree is staggering. You'll want to factor that in for each child. Add up your D, I, M, and E. That number, which for most people is well over $1 million, is a much more realistic starting point for your coverage amount than a random guess. Next is the term length. This should be a direct reflection of your financial timeline. The goal of term life insurance isn't to last forever. It's to last as long as you have major financial obligations and people who depend on your income. Ask yourself, when will my biggest debts be paid off? When will my kids be financially independent? If you just bought a house with a 30-year mortgage, a 30-year term makes a lot of sense. If your kids are 8 and 10 years old, you'll want coverage to last at least until they're through college, so a 15 or 20-year term is a logical choice. You are essentially building a financial safety net that covers your family during their most vulnerable years. Once you've put in your age, health estimate, a realistic coverage amount, and a logical term length. You click that View Your Free Quotes button. And what happens next is the entire reason you use a broker like Zander in the first place. Zander is not an insurance company. They don't issue policies. They are a matchmaker. They take your information and instantly shop it across a dozen or more of the nation's top-rated insurance companies. Companies like Prudential, Banner Life, Pacific Life, AIG. The screen that pops up is a list. It's a grid of company names and monthly prices, typically sorted from the cheapest to the most expensive. And your first instinct, the one every single person has, is to look at that number one spot, the lowest price. It's tempting, so incredibly tempting to just say, that's the one. I'll take the cheapest. But this is where the most critical mistakes are made. The cheapest quote on that screen is not always the best policy for you. In fact, choosing it without understanding the fine print could be a disaster. The company offering that rock-bottom price might be known for having incredibly strict underwriting, meaning there's a good chance you won't even qualify for that rate after you apply. Or they might not offer certain features, called riders, that could be critically important for your family's situation. You see a list of names, and a dizzying array of prices. They're all different. But why? And how do you choose? Does the cheapest option automatically mean the best? The answer is a hard no. And in the next part, we're going to uncover why the cheapest policy can sometimes be the most expensive mistake you'll ever make. Think of it like this. You need a parachute. You have two options. One is a state-of-the-art, triple-checked, military-grade rig that costs $1,000. The other one is from a guy on a street corner who says, hey, this one looks pretty much the same, and he'll sell it to you for $50. Both are technically parachutes, but when you're at 10,000 feet and the engine sputters, which one do you want strapped to your back? The one that was cheap or the one that was designed to work? Life insurance is that parachute. And picking the cheapest policy without understanding why it's cheap is like jumping out of a plane with that $50 rig, crossing your fingers and hoping for the best. The problem is, you aren't the one who suffers if it fails. Your family is. So let's break down the hidden costs of a cheap life insurance policy. There are four main areas where these bargain basement policies cut corners, and each one is a potential landmine for your loved ones. First and most terrifying are the exclusions and the fine print. Let's imagine a guy named Mark. Mark is a 40-year-old software engineer, married with two young kids. He's healthy, active, and wants to do the right thing. He goes online, plugs his info into a generic quote engine, and sees a policy that's $15 a month cheaper than all the others. $15. That's a couple of fancy coffees. He thinks, it's a no-brainer. He clicks buy, answers a few questions, and gets his policy. He feels great. He's protected his family and saved money. What Mark didn't see, buried on page 17 of the policy document in dense legalese, was a hazardous avocation exclusion. Mark is an avid weekend rock climber. It's his passion, his way of de-stressing. 2 years later, a tragic accident happens on a climbing trip. His wife, devastated and grieving, files the life insurance claim, thinking that at least they won't have to worry about the mortgage or the kids' college funds. A few weeks later, she gets a letter. Claim denied. The reason? The hazardous avocation exclusion. That $15 a month he saved just cost his family $500,000. This isn't just about rock climbing. These exclusions can cover anything from scuba diving to private aviation to even certain types of travel. The cheapest policies often have the most restrictive and confusing fine print. They're cheap because the company has built more ways to not pay a claim. A quality insurance broker like Zander understands these nuances. Their process isn't just about price. It's about matching your life, your actual life with all its hobbies and passions, to a policy that will actually cover you. They know which carriers are friendly to pilots, or which ones don't penalize you for enjoying the occasional cigar. That knowledge is the difference between a piece of paper and a real safety net. The second hidden cost is the lack of future options, specifically something called a conversion privilege. This sounds technical, but it's one of the most important features of a term life policy. Right now, you're buying a policy for a set term, say 20 years. You're likely healthy, so you get a great rate. But what happens in 20 years? Maybe your health has changed. Maybe you developed a chronic condition like diabetes or had a heart issue. If you try to get a new term policy, then you could be denied outright, or the premiums could be astronomically high. A conversion privilege is your escape hatch. It gives you the right to convert your term policy into a permanent policy like a whole life policy, without having to prove you're still healthy. No new medical exam, no new questions about your health. You get to keep your coverage based on the health rating you had 20 years ago. This is an incredibly powerful feature. It's your insurance policy on your insurance policy. Many of the absolute cheapest plans on the market strip this feature out. They're betting on the fact that you won't need it. But life is unpredictable. Stripping out the conversion option is like building a house and leaving out the fire escape to save a few bucks. You hope you never need it, but if a fire breaks out, it's the most valuable part of the entire structure. Zander understands this. They prioritize policies that have strong guaranteed conversion options because they aren't just thinking about protecting your family today. They're thinking about ensuring you have options to protect them 20 or 30 years from now, no matter what life throws at you. The third, and arguably the most crucial hidden cost, is the financial stability of the insurance company itself. A life insurance policy is not a product. It's a promise. It's a promise from a company that decades from now, when your family needs them most, they will be there with a check. But what if that company isn't around anymore? What if they've been so poorly managed that they can't pay their claims? This is where something called an AM Best rating comes in. AM Best is an independent agency that's been rating the financial strength of insurance companies for over a century. Think of it like a credit score but for insurers. It's a grade on their ability to meet their financial obligations. The ratings go from A++, which is superior, all the way down to D, which is poor. You might find an insurance company offering a policy that's $10 a month cheaper, but they have a B+ rating. A larger, more stable company with an A+ rating is $10 more. Is saving $120 a year worth the risk, however small, that the company holding your family's entire financial future could go under? Absolutely not. It's a catastrophic risk for a trivial reward. This is a non-negotiable principle for Zander. They have a strict ironclad rule. They only work with companies that have an AM Best rating of A or better. They've already filtered out the financially weaker companies. When you get a quote from them, you are only choosing from among the most stable, secure, and reliable insurers in the entire country. They've taken the $50 street corner parachute off the table completely. Finally, the fourth hidden cost is the claims process itself. Let's be honest. If your family ever has to use this policy, it will be during the worst, most traumatic time of their lives. The last thing they need is a battle. The last thing they need is an insurance company that makes them jump through hoops, that loses paperwork, that delays payment for months on end while they're trying to plan a funeral and figure out how to live without you. Top-tier insurance companies, the ones Zander partners with, have streamlined, compassionate, and efficient claims processes. They understand the human element. They have dedicated teams to help your beneficiaries through the process with dignity and speed. Cheaper, lower-rated companies often cut costs in customer service and claims processing first. This means long hold times, unreturned calls, and a bureaucratic nightmare for a grieving spouse. The peace of mind that comes from knowing the process will be handled smoothly and professionally is invaluable. It's a benefit you never see on a quote sheet, but it's one of the most important features of the policy you buy. So when you see that one policy is cheaper than another, you have to ask yourself why. Is it because it has a hidden exclusion that could invalidate your entire policy? Is it because it's missing the critical option to convert it in the future? Is it because the company itself is standing on shaky financial ground? Or is it because they'll make your family fight tooth and nail to get the money they're owed? The price on the screen is just one number. The true cost of a policy is hidden in its quality, its features, and the strength of the promise it represents. Zander's entire philosophy is built on navigating this complex landscape for you. They don't just find you a price, they find you value. They find you security. But how exactly do they do it? What actually happens when you fill out that form on their website? What are the specific steps they take to vet these companies and match you with the perfect policy? In the next part, we're going to pull back the curtain and become a fly on the wall inside Zander's operation. We'll follow the exact journey your application takes, from the first click on their website to the final policy in your hands, and you'll see the hidden steps they take that other brokers and search engines almost always skip. So let's begin that journey right now. You navigate to the Zander Insurance website. The page is clean, straightforward. There's a big, inviting button that says, "Get a free quote." You click it. The form that appears is exactly what you'd expect. It asks for your date of birth, your gender, your height and weight. It asks if you use nicotine products. It asks for the state you live in, the amount of coverage you're looking for, say $500,000, and the term length you want, maybe 20 years. You fill it all out in under 60 seconds. Then you click View My Quotes. Instantly, the screen populates with a list of insurance companies. You see names you recognize: Prudential, Banner Life, AIG, Pacific Life. Next to each name is a monthly premium. The numbers are surprisingly low. You see one for $28 a month, another for $30, another for $32. At this point you might be thinking, okay, this is just like every other insurance comparison website. I pick the cheapest one, fill out a form, and I'm done. And that is precisely where the journey with Zander diverges from almost everyone else. What you're looking at isn't the end of the process. It's the very, very beginning. Those quotes are just estimates. They are the best-case scenario, the preferred plus or super preferred rates reserved for people in near-perfect health with spotless family histories. For most of us, that's not reality. And Zander knows this. Other websites will let you click on that $28 quote, send you to a generic application, and then let the insurance company's unforgiving algorithm figure out that you actually have slightly high cholesterol or that your father had a heart condition. And then weeks later, you get an email saying your actual rate is $65 a month, or that you've been declined entirely. It's a bait and switch, but it's automated, so nobody has to take the blame. Zander refuses to play that game. The moment you submit that initial quote request, something happens behind the scenes that changes everything. Your information isn't just funneled into an automated system. It's assigned to a real licensed human being. They call them guides. And that term is incredibly deliberate. They are not salespeople. They don't work on commission. Let me repeat that because it's the cornerstone of their entire philosophy. The person handling your case does not make one penny more if you buy $1 million policy or a $100,000 policy. Their only incentive is to get you the best possible coverage you can qualify for, at the most affordable price. Their job is to guide you, not to sell you. Within a short period of time, you'll get a call or an email from your personal guide. They'll introduce themselves and explain the next steps. This is your first touch point with the human element that makes the Zander process so different. They're not going to pressure you. They're going to prepare you. They'll say something like, okay, we see you're interested in a 20-year, $500,000 policy. The rates you saw online are a great starting point. Now let's work together to build a strong application to make sure we can get you as close to that rate as possible, or even beat it. This is where the real work begins. You'll move on to the full application. Now this isn't a 60-second form. This is the deep dive. This is where you'll provide detailed information about your health history, any medications you're taking, your family's health history, your occupation, and even your hobbies. Are you a pilot? A scuba diver? Do you race motorcycles on the weekend? All of this matters. The application is thorough, and at first it can feel a little intimidating. You might be tempted to rush through it or fudge a few details. And your Zander guide will strongly advise you against that. Why? Because they know that the insurance underwriter will find out anyway. The Medical Information Bureau, or MIB, is like a credit report for your health. They see everything. Your guide's job is to help you present your information accurately and with the proper context. Let's say you had a minor health scare 5 years ago that's been fully resolved. On a generic online form, you might just check a box that says yes to a history of heart issues. That's an instant red flag for an automated system. It might get you an automatic denial or a sky-high premium, but your Zander guide will encourage you to provide the full story. They'll help you articulate that it was a one-time event, that you've had clean checkups ever since, that you've adopted a healthier lifestyle. You're not just a checked box. You're a person with a story. They are helping you build your case before it ever goes to the underwriter. They are your advocate, your translator, turning your medical history into a narrative the insurance company can understand and properly evaluate. Once the application is complete, this is where we see the most critical hidden step that nearly all other brokers skip. This is Zander's secret sauce. You hit submit, but your application doesn't go directly to the insurance companies. Not yet. Instead, it goes into an internal review process at Zander, conducted by a team of their most experienced case managers. They are, in essence, mock underwriters. They scrutinize your application from the perspective of an insurance carrier. They're looking for potential problems. They're looking for inconsistencies. They're looking for anything that might cause a delay, a price increase, or a denial down the line. They might see that you listed a medication but didn't specify the dosage. They know that for company A, a low dosage is acceptable, but a high dosage is an automatic rejection. So what do? Your guide calls you. They don't let the insurance company make a negative assumption. They call you and say, hey, we need to clarify the dosage on this prescription. It could make a huge difference in your final rate. They might see that you mention your parent passed away from cancer, but you didn't specify the age or type. They know that a parent passing from skin cancer at age 75 is viewed very differently from a parent passing from colon cancer at age 45. So they call you. They get the details. They add the context. This pre-underwriting process is a game changer. It prevents the vast majority of surprises. It's an extra layer of protection for you, the applicant. They are stress testing your application in-house before it ever faces the real test with the carriers. They are cleaning it up, polishing it, and making it as strong and clear as humanly possible. This single, hidden step is responsible for their incredibly high approval rate and their ability to secure the rates they quote. They are doing the hard work up front to save you from disappointment later. Only after your application has been internally vetted and polished does the next phase begin. The shopping. And again, this isn't what you think. Other brokers might use a shotgun approach. They blast your application out to 10 or 15 different companies at once to see what sticks. This is a terrible strategy. It clogs up the system and can actually hurt your chances. Multiple simultaneous applications can be a red flag for carriers. Zander does it differently. It's a strategic, targeted approach. Based on the specific details in your now perfected application, your guide knows which carriers will look at your profile most favorably. They have decades of data and experience. They know, for example, that Prudential is more lenient with well-managed diabetes than Banner Life. They know that AIG offers better rates for tobacco chewers than for cigarette smokers. They know that Pacific Life has a favorable view of applicants who have a private pilot's license, while another carrier might see it as a major risk. So, they don't send your application to everyone. They select the top 2 or 3 carriers that are the absolute best match for your unique life situation. If you're a 35-year-old marathon runner with a perfect family health history, your application will go to a different set of carriers than a 50-year-old with well-controlled high blood pressure. It's a bespoke, tailored submission process. They are acting like a world-class talent agent, knowing exactly which studios to send a particular actor's headshot to. They are putting you in the best possible position to succeed. So now your application, meticulously prepared, pre-screened for errors and contextually rich, has been strategically submitted to a handful of the most appropriate insurance carriers in the country. The digital paperwork is done. The case has been made. But the journey is far from over. Now we enter the most mysterious and often frustrating part of the process for most people. The world of the underwriter, the medical exam, and the long silent wait for a decision. This is the part of the journey where the control is no longer in your hands. You've done your part. You've answered the questions, you've signed the forms, and you've submitted your life story in brief to a complete stranger. Now, that story enters a kind of black box, a process shrouded in mystery called underwriting. And for the next 4 to 8 weeks, your financial future and your family's protection will be analyzed, scrutinized, and ultimately decided upon by a person you will never meet. The life insurance underwriter. So who is this person? Let's pull back the curtain. The underwriter isn't some shadowy figure in a back room looking for a reason to say no. In reality, they are a highly trained risk analyst. Think of them less as a judge and more as a biographer. Their job is to write the most accurate, detailed, and impartial story of your life, but with a very specific focus: your mortality risk. They are tasked with one single monumental question. Based on all available data, what is the statistical probability that you will live to a ripe old age? Every piece of information they gather is a chapter in that biography, a clue that helps them paint a complete picture. And the first and most important chapter they need to write comes from the medical exam. For many, this is the most nerve-wracking part. The idea of a stranger coming to your home to draw blood and ask personal questions can feel invasive. But let's demystify it, because understanding the why makes the what so much less intimidating. When Zander arranges your medical exam, they're not sending a doctor to give you a pass-fail test. They are sending a licensed paramedic or phlebotomist, a medical professional, to simply collect data points. That's it. It's a data-gathering mission. The process is designed for your convenience. They come to you at your home or your office at a time that works for your schedule. The whole thing usually takes about 20 to 30 minutes. They'll take your height and weight, check your blood pressure and pulse, collect a small blood sample and a urine sample, and ask you some of the same health questions that were on your application. They are simply verifying the information you've already provided. Here's a pro tip that can make a real difference. Schedule your exam for first thing in the morning. Why? Because you'll need to fast for about 8 hours beforehand, and it's a lot easier to do that overnight while you're sleeping. Fasting ensures the most accurate readings on your blood work, particularly for things like cholesterol and glucose levels. Also, avoid caffeine, nicotine, and strenuous exercise right before the exam, as these can temporarily spike your blood pressure or heart rate. You want the data they collect to be a true representation of your normal resting state. The blood and urine samples are sent to a lab where they are screened for a whole host of things. They're looking at your cholesterol levels, your liver and kidney function, blood sugar levels to check for signs of diabetes, and screening for nicotine, tobacco, and drug use. It's an incredibly detailed snapshot of your internal health. In fact, it's one of the hidden benefits of applying for life insurance. You're essentially getting a comprehensive health screening, and a copy of the results is available to you. It's a free look under the hood of your own health. But the underwriter's biography of you doesn't stop with the medical exam. That's just the first draft. Now the real investigative work begins, and they start pulling in data from sources you probably didn't even know existed. The first is the MIB, or the Medical Information Bureau. The name sounds ominous, like something out of a spy movie, but its purpose is actually quite simple. The MIB is a non-profit organization, a cooperative data exchange formed by insurance companies in the US and Canada. Think of it like a credit bureau, but for your medical and application history. When you apply for insurance, whether it's life, health, or disability, the insurance company can report certain coded information about your health conditions to the MIB. If you later apply for insurance with a different company and conveniently forget to mention that you were treated for, say, a heart condition 2 years ago, the underwriter can do a quick check with the MIB. They won't see your detailed medical records, but they will see a code that says, "Hey, this applicant previously disclosed a cardiovascular issue on another application." It's not there to punish you. It's there to prevent fraud and ensure that the information you're providing is consistent and complete. It keeps the system honest for everyone, which helps keep premiums down. Next, the underwriter will almost certainly pull your prescription history report. Yes, that's a thing. Every time you fill a prescription at the pharmacy, it's logged in a secure database. Underwriters, with your signed authorization from the application, can access this history. This is often one of the most revealing pieces of the puzzle for them. You might say on your application that you're in perfect health, but if your prescription history shows you've been consistently filling a prescription for metformin, the underwriter knows they need to investigate for diabetes. If you're taking a daily statin, they know to look closer at your cholesterol and heart health. The medications you take tell a story about the conditions you manage, and it's a story the underwriter needs to read. But the biography isn't just about your physical health. It's also about your lifestyle and your habits. Which brings us to the next source, your motor vehicle record, or MVR. They will pull your driving record from the DMV. What does driving have to do with life insurance? It's all about risk assessment. A record of multiple speeding tickets, reckless driving convictions, or especially a DUI, paints a picture of a person who may engage in high-risk behavior. From a purely statistical standpoint, that behavior correlates with a higher mortality risk, and it's a factor they have to consider when pricing your policy. Now the underwriter has the results from your medical exam, the report from the MIB, your prescription history, and your driving record. But there might still be a missing chapter. Let's say your application mentioned you had surgery 5 years ago, or you're being treated for a specific condition by a specialist. The underwriter will need more detail. They will request what's called an attending physician statement, or an APS. This is a formal request sent directly to your doctor's office for your medical records related to a specific condition or time frame. And honestly, this is the single biggest reason for delays in the underwriting process. Doctors are incredibly busy people. Their offices are swamped. A request for old records from an insurance company is, understandably, not their #1 priority. It can take weeks, sometimes even a month or more, for the doctor's office to compile and send those records. This is the silent waiting period. It's the most frustrating part for you, the applicant. You've done everything asked of you and now crickets. You're left wondering what's happening. Is no news good news? Did they forget about me? This is where having an advocate like Zander becomes so critical. During this waiting game, they aren't just sitting on their hands. Their team is proactively working on your behalf. They are the ones calling the underwriter for status updates. They are the ones following up with your doctor's office, respectfully nudging them to send the APS. They are your liaison, your project manager, making sure your file keeps moving forward through the complex machinery of the insurance carrier. They bridge the communication gap, so you're not left in the dark. Finally, after weeks of waiting, all the pieces are in place. The lab results are in. The MIB and RX reports have been analyzed. Your driving record is on file. The long-awaited attending physician statement has arrived. All the disparate chapters of your risk biography have been collected. The file, now thick with data, lands on the underwriter's desk for the final review. They sit down and read your story from beginning to end. They weigh every factor: your age, your health, your family history, your lifestyle. They cross-reference the data, looking for consistency and clarity. Their entire job, everything they've been trained to do, comes down to this moment. They are about to make a final decision. They will assign you a risk classification, a rating that will determine not only if you are approved, but exactly how much you will pay for your coverage for the next 20 or 30 years. The question is, what will that rating be? Will you get the preferred plus rate you hoped for? Will a minor issue knock you down a level to standard? Or will they find something that makes you a higher risk than you thought? The silence is about to be broken, and the verdict is coming in. And then the email arrives, or the phone rings. It's your Zander guide, and they have the final offers from the insurance companies. This is the moment of truth. All that paperwork, the medical exam, the waiting, it all comes down to this. Your guide lays it out for you. They'll say something like, okay, we've heard back from the carriers. Prudential has come in at Preferred Plus. Zander Life has you at a preferred rating, and AIG has offered Standard Plus. Immediately, your mind races. Preferred Plus, that sounds good, right? But what does it actually mean? What's the real-world difference between that and Standard Plus? This isn't just about labels. It's about your money. It's about the real hard dollar cost you'll be paying every single month for the next 20 or 30 years. This is the part of the process that separates the savvy consumer from everyone else, because understanding these tiers is the key to knowing if you're getting a great deal, a fair deal, or a raw deal. Let's break it down, because this is probably the most important financial vocabulary you'll learn in this entire process. Think of it like a report card for your health and lifestyle. At the top of the class, you have Preferred Plus, sometimes called Super Preferred. This is the A-plus student. This rating is for people in excellent health, with a fantastic family health history, ideal height and weight, clean driving record, no risky hobbies, and a recent clean medical checkup. This is the lowest possible price you can get. It's the gold standard. One step down is Preferred. This is the solid A. You're still in great health, but maybe there's a minor issue. Perhaps your cholesterol is a tiny bit elevated, or your blood pressure is well controlled with one medication. Maybe a parent had a health issue before age 60. You're still considered a very low risk, and you're going to get a fantastic rate, just a notch below the absolute best. Next, you have Standard Plus. This is your B. This is for the average healthy American who might have a couple of minor, well-managed health concerns. Maybe you're a bit overweight according to their charts, or you have slightly elevated blood pressure and cholesterol. Nothing serious, but enough to move you out of the preferred categories. The price here is still very competitive and affordable for most people. Finally, there's Standard. This is the C grade. It means you're an average risk. You might be significantly overweight, have a history of a health condition that's now resolved, or maybe you have a less than perfect driving record. You're still insurable at a regular rate, but it's the baseline. Below this, you get into what are called table ratings, which are for higher risk individuals, and that's a topic for another day. Now, why does this matter so much? Let's put some real numbers to it. Let's say you're a 40-year-old man applying for a 20-year, $500,000 term life policy. If you qualify for Preferred Plus, your premium might be around $30 a month. That's the best case scenario. If a slightly elevated blood pressure reading knocks you down to the preferred category, your rate might jump to $38 a month. Not a huge leap, but that's nearly $1,000 extra over the life of the policy. If you get a Standard Plus rating because you're carrying an extra 20 pounds, that premium could be closer to $55 a month. And if you land in the standard category, you could be looking at $70 a month or more. Look at that difference. From $30 to $70 a month for the exact same $500,000 death benefit. The only thing that changed was the underwriter's perception of your risk. Over 20 years, the person who got the Preferred Plus rating will pay a total of $7,200. The person who got the standard rating will pay $16,800. That's a staggering $9,600 difference. That's a car. That's a kitchen remodel. That's a lot of college tuition. This is why the underwriting verdict is so critical. So, while you were waiting, what exactly were those underwriters doing? They weren't just sitting on your application. They became financial detectives, and you were their number one case. Their job is to build the most accurate, complete picture of your life and your health, using a very specific set of tools. First, they scrutinized the results from your medical exam. They looked at the blood panel, checking for everything from cholesterol levels and liver enzymes to signs of nicotine or drug use. They analyzed your urine sample. They reviewed the blood pressure readings, your height, and your weight to calculate your BMI. This is the foundational piece of their investigation. But they don't stop there. If you mention any past medical conditions, even minor ones, they likely ordered an attending physician statement or an APS. This is where they request your actual medical records directly from your doctor's office. They want to see the doctor's notes, the official diagnoses, and the treatment plans. This is to verify what you said on your application. Did you say your high blood pressure was well controlled? Your doctor's records will prove it. Next, they ran your name through a special database called the MIB, the Medical Information Bureau. This is the one most people have never heard of. The MIB is like a credit bureau, but for your medical and life insurance application history. Every time you apply for individually underwritten life, health, or disability insurance, the insurance company reports certain information about you to the MIB. So, if you applied for a policy 5 years ago and were rated down for high cholesterol, or if you disclosed a particular medical condition, that information is in your MIB file. The underwriters check this file to make sure the story you're telling them now matches the story you told in the past. It's a way for them to catch inconsistencies or undisclosed information. Simultaneously, they're checking your prescription history. They have access to databases that show all the medications you've been prescribed over the last several years. This is an incredibly powerful tool for them. You might forget to mention you were prescribed an inhaler 3 years ago for a bout of bronchitis, but the prescription database won't forget. It gives them an unvarnished look at your health history through the lens of the medications you've taken. And finally, for many policies, they'll pull your motor vehicle report or MVR. Are you a safe driver? Or do you have a history of DUIs, reckless driving, or a string of speeding tickets? To an insurance company, a risky driver is a higher mortality risk, and it will absolutely affect your rate. So, they take all these pieces, the medical exam, the doctor's records, the MIB file, the prescription history, and your driving record, and they put them together like a puzzle. Each piece helps to build a complete profile of you. And this is often where the surprises happen. You might get a standard rating and be completely shocked, thinking, "But I'm healthy." But the underwriter saw that 5 years ago, your doctor noted you were a social smoker in your chart even if you quit right after. Or they see a prescription for a medication that you only took for a short time and forgot about, but it's associated with a more serious condition. It's these small forgotten details that can easily bump you from one category to another. This is where having an independent broker like Zander becomes your secret weapon. Remember that initial result? Prudential at Preferred Plus, Banner at Preferred, and AIG at Standard Plus. Each insurance company has its own unique underwriting guidelines. They're like different judges interpreting the same evidence. One company might be very strict about BMI but more lenient on family history. Another might be the exact opposite. A captive agent who only works for one company can only give you that one company's offer. If AIG was their company, they'd come back to you with a Standard Plus offer, and you might think that's the best you can do. But Zander, because they work with dozens of carriers, can see all the offers at once. Their job isn't just to bring you the offers, it's to analyze them. They know which company is best for someone with well-controlled diabetes, or which one is more forgiving of a past DUI. They see that Prudential came in with the best possible rating and can immediately tell you, "This is the one. This is the lowest price you will find." They do the comparison shopping for you using the real final underwritten offers. They become your advocate, ensuring you're not just getting a policy, but you're getting the absolute best rating and price you qualify for across the entire market. But what happens if all the offers come back lower than you expected? What if the best you get is standard and you feel you deserve preferred? Are you just stuck with that verdict? Is the case closed? Not even close. You have rights and you have options. And knowing what to do next can save you thousands of dollars and turn a disappointing outcome into a major win. So the insurance company sends you a letter, and it's not the one you were hoping for. Instead of the Preferred Plus rate you felt you earned, they've offered you Standard. Your premium is 30, 40, even 50% higher than you budgeted for. The first feeling is usually a mix of confusion and frustration. You think, "Wait a minute. I'm healthy. I don't smoke. I'm in good shape. How is this possible?" Feels like a judgment. It feels like a final verdict handed down from some mysterious, all-knowing entity. But here's the single most important thing you need to understand in that moment. It's not a verdict. It's an offer. That's it. The insurance company has reviewed your file and made you an offer of coverage at a certain price. And just like any other offer, you don't have to automatically accept it. Your first move isn't to get angry or to give up. Your first move is to become a detective. You need to get on the phone with your Zander guide, or directly with the carrier's underwriter if possible, and ask one simple, powerful question. Can you please tell me the specific reason for this rating? Now they won't just say your health. That's not good enough. You need specifics. Was it a particular reading from your blood test? Was it a note in your doctor's records from 3 years ago? Was it something on your MIB report? You need to know the exact piece of data that caused the underwriter to move you from one category to another. This is your right. You are entitled to know why you were rated the way you were. Let's imagine a real-world scenario. Let's call our guy Mike. Mike is 42, a non-smoker, exercises regularly, and applied for $1 million 20-year term policy. The Zander quote tool showed him a preferred plus rate of about $60 a month. He felt great about it. He does the medical exam, everything seems fine, and then 2 weeks later he gets the offer. It's for a standard rating, and the premium is now $95 a month. That's an extra $420 a year, or $8,400 over the life of the policy. Mike is understandably upset. He's about to just accept it because he thinks he has no other choice. But instead he calls his Zander guide. The guide tells him, "Mike, let's find out exactly what's going on." They contact the underwriter and discover the culprit. A single elevated liver enzyme reading from the blood test. Mike is baffled. He says, "But my doctor says I'm perfectly healthy." The guide asks him to think back. Was there anything unusual around the time of your exam? Mike thinks for a moment, and then it hits him. The week of the exam, he'd been taking a high dose of over-the-counter pain reliever for a pulled muscle in his back. He didn't think it was a big deal. But as it turns out, heavy use of certain common medications can temporarily elevate liver enzymes and send up a red flag for an underwriter who doesn't have the full context. All they see is a number on a lab report that falls outside the preferred plus range. So what happens next? This is where you move from detective to advocate. Mike's Zander guide advises him on the next steps. First, get a letter from your primary care physician. Mike goes to his doctor and explains the situation. The doctor, who knows Mike's health history, is happy to write a brief letter stating that Mike is in excellent health, that the elevated enzyme reading was a temporary and explainable anomaly likely caused by the medication, and that it is not indicative of any chronic condition. Second, Mike's guide suggests he get a new independent blood test done at his own expense, now that he's off the medication. He does, and sure enough, all his levels are perfectly normal, right in the heart of the preferred plus range. Now Mike has a case. He has new evidence. He's not just complaining about the decision. He is actively disproving the data that led to the decision. He and his Zander guide submit what's called a request for reconsideration to the insurance company. They include the doctor's letter and the new lab results. They are presenting a revised picture of Mike's health, one that is more accurate and complete. The underwriter now has new information to consider. They aren't just looking at a single context-free data point anymore. They're looking at a holistic view of a healthy individual, with a documented, logical explanation for the previous anomaly. And what do you think happens? About 3 weeks later, Mike gets a new letter in the mail. The insurance company has reviewed his file and the new evidence. They have overturned their initial decision. He is now approved at the preferred plus rate of $60 a month. By taking a few proactive steps, by refusing to accept the initial offer as the final word, Mike saved himself $8,400. That's a serious win. This isn't a rare one-in-a-million story. It happens all the time and for all sorts of reasons. Maybe your medical exam was on a stressful day. You were rushing from a bad meeting at work, you had too much coffee, and your blood pressure reading came back a little high. That's called white coat syndrome, and it's incredibly common. A simple follow-up with a series of normal readings from your doctor, or even a home monitoring kit can often solve that. Or maybe there's an error on your MIB report. The Medical Information Bureau is essentially a credit bureau for your health history, and just like a credit report, it can contain mistakes. Maybe a code for a condition you were tested for but didn't have was never removed. You have the right to request a copy of your MIB report and dispute any inaccuracies. Correcting a single error on that report can be the difference between a standard and a preferred rating. Sometimes it's a matter of context around your lifestyle. Let's say you put on your application that you scuba dive. The underwriter might see that and immediately flag you as high risk, bumping you down a category. But what they don't know is that you get certified on vacation once every 5 years and only dive in calm, shallow waters with a guide. You're not a deep-sea cave diver exploring shipwrecks every weekend. Providing a detailed letter explaining the frequency and nature of your hobby can give the underwriter the context they need to reevaluate their risk assessment and give you the better rate you deserve. The key takeaway here is that you are your own best advocate. The initial underwriting process is fast and built on assumptions. An underwriter might spend only a few minutes on your file, looking for black and white data points that fit into their neat little boxes. Your job, if you get a rating you don't agree with, is to provide the color, the context, and the new evidence that forces them to look at your file again, not as a set of numbers but as a complete human being. Zander's role in this is crucial. They are your coaches. They've seen every possible reason for a downgrade, and they know the exact steps to take to challenge it. They know what kind of evidence is most persuasive to an underwriter and how to package it for a successful reconsideration. This is a level of service you simply don't get from a faceless online algorithm. So never ever assume the first offer is the last word. Challenge it. Investigate it. Build your case. It might take a few phone calls and a bit of paperwork, but the potential savings, as we saw with Mike, can be absolutely massive. You have more power in this process than you think. But what if the situation is reversed? What if you got a great rate years ago, but since then, your health has taken a turn for the worse? Are you at the mercy of the insurance company, just waiting for them to jack up your rates? Or is there a little-known feature hidden in many term life policies that can lock in your good health forever, no matter what happens down the road? Understanding this one feature could be the most important financial decision you ever make. This feature is called the term conversion privilege, and it is, without a doubt, the single most powerful and most overlooked feature baked into a quality term life insurance policy. It acts as a permanent guarantee of your insurability. It's a contractual promise from the insurance company that says, "We don't care what happens to your health in the future. We will always honor the you that we approved today." To truly understand its power, let me tell you a story. It's a story that plays out in thousands of households across America every single year. Meet Mark. At 35 years old, Mark is the picture of health. He runs a few times a week, his blood pressure is perfect, and he's never had a serious medical issue in his life. He and his wife have 2 young kids, a new mortgage, and big dreams. He knows he needs life insurance, so he does his research and ends up using a service like Zander to shop the market. He gets a fantastic Preferred Plus health rating, the best you can get. For $1 million 20-year term policy, his premium is incredibly low. He signs the paperwork, sets up the auto payment, and feels a wave of relief. He's protected his family. Tucked away in the dense legal language of his policy document is a clause about convertibility. He might have glanced at it, but it didn't really register. Why would it? He's 35 and healthy. The idea of needing to convert his policy seems a million miles away. He files the document away and, for the most part, forgets about it. Now let's fast forward. 20 years fly by in the blink of an eye. The kids are now in college. The mortgage balance is a fraction of what it once was. Life has been good. Mark is now 55. He's not as lean as he was at 35, but he's still in decent shape, or so he thinks. During a routine physical, his doctor notices something irregular. A few tests later, Mark gets the news that rocks his world. He has a serious heart condition that will require ongoing management and medication for the rest of his life. It's treatable, but it's a permanent, pre-existing condition. A few months later, an official-looking envelope arrives in the mail. It's from his life insurance company. It's a courtesy notice. Your 20-year term policy is set to expire in 6 months. A cold dread washes over Mark. His $1 million safety net is about to vanish. His first thought is, "No problem, I'll just get a new policy." He goes online, starts filling out an application, and gets to the health questionnaire. Have you ever been diagnosed with or treated for a heart condition? He clicks yes. The application is instantly denied. He tries another company. Denied. He calls an agent who tells him the brutal truth. With his new diagnosis, he is now considered uninsurable by most standard carriers. The few that might offer him a guaranteed issue policy would charge an astronomical premium for a tiny fraction of the coverage he once had. The panic sets in. The peace of mind he's had for 2 decades is gone. His kids still have student loans. His wife is counting on a secure retirement. What if something happens to him now? The very risk he insured against has become a reality, and his shield is about to be taken away. He feels trapped, like he's being punished for a health issue that wasn't his fault. This is the nightmare scenario for every person who buys term life insurance. You outlive the term, but your health has changed, leaving your family exposed right when they might need the protection most. Desperate, Mark digs through his old files and finds that original policy document from 20 years ago. He calls the number for customer service, or maybe he calls Zander, hoping for a miracle. He explains his situation, his voice full of anxiety, and that's when the guide on the other end of the line says the words that change everything. Mark, it's okay. Your policy has a conversion privilege. Suddenly, the forgotten clause from 2 decades ago becomes the most important financial tool he has ever owned. Here's what it means. The insurance company is contractually, legally obligated to allow Mark to convert his temporary, 20-year term policy into a permanent policy, like a whole life or universal life plan. And here is the most critical part. He does not have to answer a single health question or take another medical exam. The company must issue him this new permanent policy based on the health class he qualified for 20 years ago. They have to give him a policy based on the 35-year-old perfectly healthy Mark, not the 55-year-old Mark with a heart condition. He has locked in his good health forever. Now it's not a free lunch. There's a catch, but it's a fair one. The premium for his new, permanent policy won't be the same low rate he was paying for his term plan. The new rate will be based on his current age of 55. This makes sense. A policy designed to last for the rest of your life that is guaranteed to pay out is naturally going to cost more than a policy that only covers you for a specific period. The price is for a 55-year-old, but, and this is the key, it's for a healthy 55-year-old. He's getting a price that, without the conversion privilege, would be completely impossible to obtain. He is getting access to coverage he otherwise could not buy at any price. But the flexibility doesn't stop there. Mark realizes he doesn't need the full $1 million in coverage anymore. The mortgage is almost gone and the kids are nearly independent. He really only needs about $250,000 to cover final expenses, pay off the last of the debts, and leave a comfortable inheritance for his wife and a gift for his kids. So he executes what's called a partial conversion. He converts just $250,000 of his original $1 million term policy into a new permanent policy. The other $750,000 of term coverage simply expires as planned. By doing this, the premium for his new permanent policy is much more affordable, fitting easily into his pre-retirement budget. He went from the brink of having no coverage and no options, to having a permanent guaranteed $250,000 policy that will protect his family for the rest of his life. All because of a single clause in his original contract. This is why when you work with a broker like Zander, they aren't just looking for the cheapest possible price for today. They are ensuring the policies they recommend are from A-rated or A-plus rated companies that include a strong, flexible conversion privilege. It's a non-negotiable part of a quality policy. It's the ultimate backup plan. It transforms your term policy from a simple, if you die plan into a sophisticated, when you die plan, giving you the power to decide later, when you have more information about your health and your finances. So, the conversion privilege is your safety net if your health declines. But that raises an equally important question. What if you're like most people? What if you get to the end of your 20 or 30-year term and you're still perfectly healthy? You've paid all these premiums for decades and thankfully you never needed it. Is all that money just gone? Or are there other options for a healthy person at the end of their term? This is one of the most common and frankly one of the most important questions people have about term life insurance. It's the elephant in the room. You do the responsible thing, you pay your premiums for 20 or 30 years, you protect your family, and then the term ends, and you're still here, which is fantastic. But it can feel like you just paid rent on a house for 30 years and now you have nothing to show for it. Is that money just vanished into thin air? The simple answer is yes. For a standard term policy, that premium money is gone. But thinking of it that way is looking at it through the wrong lens. You didn't pay for an investment, you paid for protection. It's exactly like your car insurance. You pay it every month and you hope you never ever have to use it. If you go 30 years without a major car accident, you don't call up your auto insurer and ask for your money back. You breathe a sigh of relief. You got exactly what you paid for. Peace of mind and protection against financial catastrophe. Life insurance is the same. The money you paid ensured that if the worst happened, Your family wouldn't have lost their home or their future. That protection has immense value, even if you never file a claim. But the more important answer to that question, are there other options for a healthy person at the end of their term? Is a resounding yes. You are not stuck. In fact, you have several powerful choices to make, and understanding them is key. Let's break them down. Your first option is the simplest: you can do nothing. You can let the policy expire. Your coverage ends, you stop paying the premiums, and you both go your separate ways. For many people, this is actually the correct and intended outcome. Think about it. Why did you buy a 30-year term policy in the first place? You bought it to cover a 30-year mortgage. You bought it to make sure your kids could get through college. You bought it to replace your income until you reach retirement age. Now, 30 years later, the house is paid off. The kids are grown and have their own careers. And hopefully, you followed the buy term and invest the difference philosophy, and you have a substantial nest egg. You're self-insured. You don't need life insurance anymore, because your spouse would be financially secure without your income. In this scenario, letting the policy expire is the finish line. It's the victory lap. You won the game. But what if that's not your situation? What if you're at the end of your term but you find you still need coverage? Maybe you had children later in life, maybe you took on a new business debt, or maybe you just want to leave a larger inheritance. You still need insurance. This brings us to your next set of options. Most term policies sold through a broker like Zander come with a critical feature called a conversion privilege. This is your secret weapon. A conversion privilege allows you to convert all or a portion of your term policy into a permanent policy, like whole life insurance, without having to prove your insurability. Let me say that again because it's that important. Without a new medical exam. Now, you know the philosophy we've discussed. For 99% of people, expensive whole life insurance is not the right product. But this conversion option is the exception that proves the rule. It's a safety net for a very specific and very serious what-if scenario. Imagine you're 55 years old, and your 20-year term policy is about to expire. But 3 years ago, you were diagnosed with a serious heart condition. You are now, for all intents and purposes, uninsurable. No company will sell you a new policy at any price. You still need to protect your family, but you can't pass a medical exam. This is where the conversion privilege becomes one of the most valuable things you own. You can call the insurance company and exercise your right to convert that term policy into a permanent one. Yes, the premiums will be significantly higher because permanent insurance is more expensive and you're now 20 years older. But you will have coverage. You get to keep your protection in place when every other door has been slammed shut. Zander makes sure the policies they shop for have this feature precisely for this reason. It's a fail-safe. It's the parachute you hope you never need, but it's there. Okay, but let's go back to the original question. What if you're healthy at the end of your term and still need coverage? In this case, converting to an expensive whole life policy is probably not your best move. Your best option is likely to simply buy a new term life insurance policy. You're older, so the premiums will be higher than they were 20 or 30 years ago. That's a fact of life. A healthy 60-year-old will pay more than a healthy 30-year-old. But you might not need as much coverage or as long of a term. Maybe you just need a smaller 10-year policy to get you to the point where your pension kicks in or your last debt is paid off. This is where you would call Zander again. Their team would reevaluate your current needs, your debts, your assets, your family situation, and then they'd go back to the market and shop all the top companies again to find you the best possible rate for a new shorter-term policy that fits your new reality. For a healthy person, this is almost always a more cost-effective solution than converting to a permanent policy. Now, there is one more option you might hear about, and I need to address it because it sounds so tempting on the surface. It's called a return of premium, or ROP life insurance policy. The sales pitch is incredible. You get a term life policy, and if you outlive the term, the insurance company gives you back every single dollar you paid in premiums. It sounds like a can't-lose proposition, right? Free insurance. But there is no free lunch. A return of premium policy costs significantly more than a standard term policy. Often 30% to 50% more, sometimes even double. You are paying a huge surcharge for that get your money back feature. And here's the catch. That extra money you're paying could be working so much harder for you if you just invested it yourself. Let's do some simple math. Let's say a standard 30-year term policy costs you $100 a month. An ROP policy with the same death benefit might cost you $150 a month. That's an extra $50 every single month. Over 30 years, that's an extra $18,000 you've paid. At the end of the term, the ROP policy gives you back your total premiums, which is $54,000. So you got your $18,000 back plus the rest. Sounds okay. But what if you bought the standard $100 policy and invested that extra $50 every month? If you put that $50 a month into a simple, conservative investment averaging a 7% return over 30 years, you would have over $60,000. You'd have more money than the ROP policy gave you back, and you would have had control over that money the entire time. If you had a financial emergency in year 15, you could access your investment. With the ROP policy, that extra cash is locked up with the insurance company. This is why Zander and virtually every other trusted financial advisor will tell you to avoid the gimmick of ROP policies. Stick with the most affordable, high-quality term life insurance you can find and invest the difference yourself. You will always come out ahead. So as you approach the end of your term, you are in the driver's seat. You can let it expire because you've achieved financial independence. You can, if you're healthy, shop for a new, smaller policy to cover your remaining needs. Or if your health has changed, you can use the powerful conversion privilege to guarantee you remain insured. The money you spent on premiums wasn't wasted. It bought you decades of security and left you with a powerful set of options for the future. Understanding these choices is the final piece of the puzzle in managing your policy. But there's one last area we need to explore. We've spent all this time talking about what happens if you live. But what happens if you don't? What is the actual experience for your family when they have to make that dreaded phone call and file a claim? How does Zander and the insurance company handle that process during what is arguably the most difficult time in your family's life? This is the moment of truth for any life insurance policy. It's the reason you pay your premiums month after month, year after year. And it's a process cloaked in fear and uncertainty for many. So let's pull back the curtain. When your family needs to file a claim, the first call can be to Zander or directly to the insurance carrier listed on the policy documents. This is a critical point. Zander will advocate on your behalf, but the check is ultimately cut by the insurance company itself, the A-rated carrier you selected. Zander's role here is that of a guide and an ally. They have a dedicated claims support team. Their job is to help your grieving family navigate the paperwork, understand the requirements, and ensure the claim is submitted correctly and promptly to the carrier. They know what documents are needed, primarily a certified copy of the death certificate and the claimant statement form. They can help your beneficiary fill out the forms, answer their questions, and act as a liaison with the insurance company, which can be invaluable during a time of immense stress and emotional turmoil. Imagine trying to decipher legal jargon and follow up on claim statuses while planning a funeral. Having a professional advocate in your corner is a significant, though often overlooked, benefit of using a good broker. Once the claim is submitted to the carrier, the insurance company begins its review. Now, you've probably heard horror stories about insurance companies trying to weasel out of paying. And while disputes can happen, it's exceedingly rare, especially for policies that are past the 2-year contestability period we discussed earlier. If the death occurs within those first 2 years, the insurance company will conduct a thorough investigation to make sure there was no material misrepresentation on the application. They'll pull medical records and cross-reference everything. This is why absolute honesty on your application is non-negotiable. But if you were truthful and the policy has been in force for more than 2 years, the process is typically straightforward. The carrier verifies the policy is active and that the cause of death is covered. For most term life policies, the only major exclusions are suicide within the first 2 years and certain acts of war. Once verified, the claim is approved. Most states have laws requiring insurers to pay claims promptly, often within 30 to 60 days of receiving the necessary paperwork. The benefit is then paid out to your named beneficiary, tax-free, as a lump sum or in another agreed-upon settlement option. Zander's team stays involved, tracking the progress and helping to resolve any delays, pushing the carrier to honor their commitment. So in the darkest of times, they don't just disappear. They step in to help ensure the promise that was made to you is kept for your family. So with all of this on the table, from the initial quote process to the final claim, we arrive at the ultimate question after this deep dive. Is Zander Life Insurance worth it? The answer, like most things in personal finance, is it depends entirely on who you are and what you need. Let's break down the final verdict. The single biggest argument for Zander is its unwavering commitment to a specific philosophy. Buy low-cost term life insurance as a tool for income replacement and invest the difference. This clarity is their strength. They are not trying to be all things to all people. They are specialists in the world of term life. Because they are an independent broker representing dozens of top-rated companies, you are almost guaranteed to see a competitive landscape of quotes. You aren't being shoehorned into a single carrier's expensive product line. Their process is efficient, streamlined for the digital age, and free from the high-pressure sales tactics that plague so much of the insurance industry. The endorsement from Dave Ramsey isn't just marketing. It's a stamp of approval that aligns with a philosophy of debt freedom and straightforward financial planning that resonates with millions of Americans. If you believe in that philosophy, Zander speaks your language. They provide education, they simplify the complex, and they facilitate the purchase of a product that is, for most people, the right type of life insurance. However, there are arguments against Zander, or at least reasons why they might not be the perfect fit for everyone. Their laser focus on term life means that if you have a genuine need for a permanent policy, perhaps for complex estate planning, funding a special needs trust, or business succession, Zander is not your ideal partner. They can sell these products, but it is not their core competency, and their agents are not trained to be specialists in high net worth estate preservation strategies. Furthermore, the Zander model is built on volume and efficiency. It's a call center-based approach. You might speak to a few different people throughout the process. If you are someone who craves a deep, long-term relationship with a single, dedicated financial advisor who knows your family's story inside and out and meets with you in person year after year, the Zander experience might feel impersonal. You are a valued customer, but you are one of many. There's less of that traditional, face-to-face hand-holding. Some critics also point out that while Zander is a broker, they are still a middleman. You could, in theory, go directly to many of these insurance carriers yourself. The value Zander provides is in the curation, the comparison, and the advocacy, but you have to decide if that service is worth it to you versus going it alone. So let's make this crystal clear. Who is Zander perfect for? Zander is the ideal choice for the individual or family who aligns with the Dave Ramsey baby steps approach to finance. You see debt as the enemy and wealth building as your goal. You understand that the primary purpose of life insurance is to replace your income and protect your dependents during your working years. You are looking for the most affordable, straightforward term life policy from a reputable company, and you want to compare the best options without being upsold on complicated, expensive permanent insurance. You are comfortable handling the majority of the process online and over the phone, and you value efficiency and clear, no-nonsense advice. If you hear the words buy term and invest the difference, and you nod your head in agreement, Zander was practically built for you. Now, who should probably look elsewhere? You might want to consider other options if your financial situation is highly complex. If you have a high net worth and need life insurance as a sophisticated tool for estate tax mitigation, business planning, or creating generational wealth, you would be better served by a fee-based financial planner or an insurance specialist who focuses exclusively on those advanced strategies. If you are someone who deeply values a personal, one-on-one relationship with a local agent, you can meet for coffee and review your entire financial portfolio with. Zander's more transactional, phone-based model will likely fall short of your expectations. And finally, if you have a very challenging health history, multiple, severe, or rare conditions, you might benefit from a niche broker who specializes in impaired risk underwriting. While Zander can handle many health issues, a true specialist in your specific condition might have access to underwriting programs or carriers that others don't. So, after 10 parts, what is the single most important takeaway from all of this? It's not that Zander is good or bad. It's that you are now armed with the knowledge to make an informed decision for yourself. You understand the why behind life insurance. You know the difference between term and whole life. You see the value of an independent broker, and you recognize the importance of A-rated carriers. You know what to expect during the application, the medical exam, and even the claims process. Zander is a tool, a very effective tool for a very specific and very large group of people. But it is just one tool in the toolbox. The goal of this entire series was not to sell you on Zander. The goal was to sell you on the profound importance of protecting your family. It's about making sure the lights stay on, the mortgage gets paid, and your kids can still go to college if you are no longer here to provide for them. It's about turning your love into a tangible legacy of security. Your homework today isn't to immediately go to Zander's website. Your homework is to sit down tonight, look at your spouse, look at your kids, and have a real conversation. Ask the hard questions. What would happen if I wasn't here tomorrow? Are we protected? If the answer is no, or I don't know, then your next step is to take action. Get a quote. It costs you nothing but a few minutes of your time. Get a quote from Zander. Get a quote from Policy Genius. Call a local independent agent. I don't care who you choose. What I care about is that you choose to act. Don't let another day go by with your family, your finances, and your future left vulnerable. The most expensive life insurance policy is the one you needed but didn't have. You have the knowledge. Now go use it to protect the people you love. That is the ultimate financial victory.